I'm just sitting here processing what you just said, Mac, and I am realizing my own mortality. It's hitting me. If it's hitting you at home, you and I are on the same wavelength, because Mac just said that for the next 20 years, 10,000 people a day are turning 65. And so I happen to know that the last baby boomer officially retires in hits 65 in 2030. It is our last year of the baby boomer generation. So that's just 7 years from now. So what Mac is actually talking about is the beginning of my generation, Gen X, starting to retire. And that is what is just hitting me a ton of bricks at the, in this live show. Like, wow, he's not talking about we've been doing this for how long, Mac? And we've always said the baby boomers, the baby. No. We are now talking about the retirement of our not Shannon's, but our generation. And that's shocking. And I want to say, you said it, Mac, but let me just resonate it with the audience. Most Wall Street advisors, big box advisors, what I'm talking about, non-boutiques, they are not in the risk management space. They are in the growth space, the accumulation space. So that's why I'm just going to tell you, they're pretty poor on planning. Let's be honest. You don't have a plan. You have a statement. And they don't ever leverage risk management tools. Long-term care requires a risk management tool. And so if you bring up long-term care with your advisor, I would suggest that if they're a Wall Street advisor, 90% of the time, they're going to tell you to seek that resource outside of them and outside of their planning, if they even have a plan. So again, these people that you think are their financial advisor, they are a money manager. They are not a financial advisor. They are not delivering a financial plan. They are not assessing other outside risks and how to manage that risk with risk management tools. And long-term care, in fact, is the most devastating consequence that could ever happen to a family. Because if you don't want your family in a Medicaid bed, and I'm a lawyer, I can speak to Medicaid planning directly and directly to you. The last thing that a family wants is to plan on a Medicaid bed. That would be the bed of last resort, as we call it. And what that means is you have to literally see an expert in Medicaid planning, and they are going to take your assets and sort of systematically, legally remove them within the legal parameters, so that you can then qualify for a Medicaid bed. So that if you have someone who has a long-term chronic condition, that Medicaid would then kick in if you have assets of a certain level underneath. So that's what a Medicaid planning attorney that just specializes in that does. But people need to understand that Medicare, not Medicaid, Medicare does not cover chronic long-term care conditions. It is a rehabilitative insurance health policy only. So once you go past that 100 days of any incident on Medicare, you are now on your own, and you're moving into the chronic status, and you're on your own. And unless you're going to take the extreme steps of Medicaid planning to get your assets and to qualify, and then you're going to be in a Medicaid bed, which, I wouldn't wish on anybody, and certainly no one in my family. So this is so huge, and just understand the limitations of your money manager who is not a financial planner.
Right. I mean, and that's so big, because we have clients that say, hey, I have to take care of my mom, my dad. They're coming into my home, and they just don't have the funds themselves to also fund their long-term care plus their mom and dad's long-term care.
Right.
They just don't have a plan.
Right.
And it's that lack of planning, that if they were able to carve out some of their assets or pay a little bit, it could have been life-changing.
Absolutely.
Could have been life-changing. And, Mac, I know you've had a lot of experience with long-term care and trying to make sure that we have the right asset for the right person. And there's different ways to do it.
There's lots of ways to do it. I think one of the biggest issues that we see, though, as an industry is a lot of advisors just don't know how to bring the subject up. They don't know how to broach the subject.
It's uncomfortable.
I think if you ask someone, hey, do you want some long-term care? The first person will say, no, I don't want these long-term care insurance. No, what are you trying to say?
Don't sell me that.
Don't sell me that stuff. And so I think that's what we do very well at this firm is we engage the conversation. We make it a goal. It's something that we have to address. And we ask you, what is the one thing that could, really blow up your plan? What's the one thing? And then once the client realizes, okay, this is what it is, then we can address it, and then we can put together some sort of solution to really make sure that that income comes into play when you need it. All of a sudden, oh yeah, we're spending $5,000 a month. All of a sudden that doubles or triples. It can be problematic.
I don't want to cry. But I'm dealing with this right now in my own family with my own parents. And I just want to say, like, you know, for you to think about your own mortality and for you to face that head on with a financial planner and address it and to take those risk management steps and really help, that's great. But a lot of people don't, and so it's their children that are doing it for them. And so what I would just say to you is, if you have parents that are, you know, over 65, that are potentially at this age where these kinds of events start occurring, and they've never had a conversation with you about what their assets are, they've never had a conversation with you about if something does happen, a dementia diagnosis, an Alzheimer's diagnosis, a other kind of chronic condition diagnosis. You know, we just saw Bruce Willis coming out this year with that horrible diagnosis of frontal lobe Alzheimer's. You know, if you have not had this conversation with your parents, yet if something happened to your parents, you would be the one in your family, as I am in my family, to figure out how to fix, you know, handle this and move on so that your parents can have the best care possible. Then you need to come in and have this conversation about your parents with us, because there are steps that can be taken to really, really help in the absence of any kind of government assistance, because Medicare is not doing it and we're not going to qualify for Medicaid. Have that conversation, come in and open this dialogue with your parents, because you will be the one that is having to figure it out if there's no plan in place.
So I know, Mac, Rebecca, I know we don't get healthier as we age. We get more sickly. We get more, you know, I'm having back problems and knee problems, and I'm like, what the heck's going on here?
Yeah, so, welcome to life.
Yes, yes. So we don't get healthier. We get more sickly, and we need to have a plan in place for that. And I know, Mac, we were talking on the break, and you're like, you know, there's so many things that we can do, and there's opportunity as long as we have the planning opportunity to do it.
Yeah, so one of my stories, and Rebecca, thank you for sharing yours before the break. I have family members that went through this, but one of the most powerful stories that I remember going through was one of my clients years ago was the former coach of Duke University. And he and his wife did the right thing. They purchased a long-term care annuity policy, a traditional one, and we're going to talk later about some of these new solutions that are out there. But the thing that really got to me was they did the right thing. They had someone that came in, but they had one of these older type of policies, and Shirley called me crying. And she said, Mac, I got my statement for this new policy, and it's so much, the expense is so high. We talk about longevity. We talk about the fact that people are living longer. That is causing a strain on some of these traditional long-term care policies. Their policy premiums went from $3,000 to $15,000 a year.
In 1 year,
In
1
1 year. So we had to sit down, we had to do a lot of different things, and we had to, you know, reduce a couple of the benefits on there. But they at least had something in place. So the reason behind that story is to let folks know, do the planning, sit down with an advisor, things will change, but there are tools that can help us and help you with your family situation when it comes to addressing something that I'm so glad that they had, because their expenses, I knew Bill's health was going down. And I knew within a year or two that they could not live without that long-term care policy. They needed it. So it's very important to sit down with an advisor that's understanding of that space, which we do here at Walzer Wealth. We talk to our clients about that.
I love that, Mac. And I just want to address what Mac just said for the viewers at home, because I think that some questions are running through your mind, and I want to address them head on. And I think we're going to talk in the next segment about more newer ways to cope with long-term care that are updated. But I want to explain, on a traditional long-term care policy, your rate, a lot of people have the misconception that their rate is set for life and that it's locked in. And that is not true. While it is true that you cannot have a premium increase, you can if the state regulatory agency body approves it. So, like, for example, in the state of Florida, unfortunately, we have a lot of retirees, and we have never had a request from the insurance group, industry that's requested a long-term care policy increase across the class. So you have to understand that long-term care rates are not individualized. They're set at the class level. And the insurance company does have the ability to go back to the insurance regulator of the state, it is state by state, and request a class-wide rate increase. So that was what Mac was talking about, is going from $3,000 to that $15,000. That was a class-wide state increase at that class level, and that is how your premiums can go up. up. Because of that uncertainty, there are newer ways that we definitely deliver long-term care. We call them hybrid assets. They have multiple purposes, one of which is long-term care. But if you don't need it for long-term care, it can still be used as another asset in your portfolio. And so we do have ways to better combat that. So don't think, well, gosh, that didn't really help that much, because, you know, and like Max said, he was able to sit back down and adjust the plan and move some things around and get that premium a lot more reasonable and fashion. But let's just be honest, those, I call them golden parachute long-term care policies, they don't exist anymore. The standalones are so cost prohibitive, either they've all stopped offering it or they're just not really worth the cost.
Right.
So we have definitely had leaps and bounds of long-term care product development in the last, I'd say, even 10 years. And that's where we are now. That's present day. But just don't have the misconception that because you have a traditional plan, you're never going to get a higher bill. That's just not reality.
Right. Well, and we know that, you know, a big concern when clients come and see us is, hey, I don't want to be a burden to my kids.
Yeah, that's the hugest thing.
Right. And a lot of times we know that women outlive men. Women are more likely to need long-term care, but there's still the not one-off chance, there's still a good probability that the man's going to need it too. And I know, Mac, you have a really great analogy. I want you to tell the viewers exactly. It is fantastic.
So thank you for recollecting that in my mind, because the story was a fascinating one. I was working with an advisor, sitting down, and he has found an amazing way to really bring home the importance of these policies, these solutions for long-term care insurance. He'll have a husband and wife sit down and he'll ask them, okay, what's your game plan should you need care, or your husband will either need care for long-term care? And typically what happens, the husband says, oh, I won't need it, you know, she'll take care of me. And he says, oh, is that what happened? So he'll ask the wife to stand up behind the husband and try lifting him. And of course, she's like, imagine having to do that between 5 to 10 times a day.
Yeah.
And that's when it hits home to couples, like, I can't do this on my own. We're going to need help. We're going to need to bring in a nurse or a medical professional to come in and take care of either myself or my spouse. So those are ways that advisors, good advisors, will sit down, have those conversations, and explain to people why it's important. And the other good thing, too, we review people's existing policies.
That's right.
So if you have a policy out there, please bring it in. Let us know what it is, and we'll be able to walk through it and let you know if what you have works, or maybe they're one of these newer type of hybrid
I'm
assets.
so glad you said that, because I'll just give you a quick example. You know, let's just say you have a traditional policy that has a $500,000 total, what I call it as bag of money that you can spend. What people think is, well, I've got $500,000, and if something happens to my wife and she needs to go into a facility for 2 or 3 years, it'll be fine. But what they don't know or understand is the fine print that gives you a per diem limit. So even if you have a total bag of money of $500,000, it might be constrained as to how much you can spend, that it might be like a spend over 10 years, and if she only needs it for 3, you're thinking that it's all covered for 3 years. And every policy is different, but that part of that review, Mac, is us sitting down and reading the actual policy and pointing it out I cannot tell you how many times I've pointed out to people that it's not the coverage they think, not that it's not enough total money, but it's just not going to be delivered as they believe in their mind. And then that's okay. It's better than nothing, of course. And then let's figure out how we can make it work with the other assets that you have if we are partially self-insuring, because it's going to take longer. So
I know we've talked so much about long-term care this show, and I know we want to kind of talk about some of these hybrids that we were talking about these past 2 segments, and how it can really, how long-term care has evolved. I mean, it's evolved so much, not only the past even 5 years, 10, 20, 30 years now. And I want to kind of talk about some of that stuff. Mac, I know you have some really good examples for us too.
Sure. So the government realized that we have this aging population, and they also realize that someone's got to pay for it. And so the Pension Protection Act of 2006 allowed for the creation of these hybrid asset-based long-term care solutions that allows people to either utilize cash flow or utilize assets to be able to leverage these assets, right? To be able to provide tax-free income for long-term care expenses. And what I love about going through the financial planning process is you sit down with folks and we look at goals and we have the things that, you know, the needs, your wants, your wishes. And then you ask them, what's the game plan should something happen to you or your spouse when it comes to your health? And the first thing they say is, oh, we're going to self-insure. And I stop them. I said, no, you're not. You're not an insurance company. You're actually going to self-fund those expenses. There's a huge difference. You're looking at your own assets to be able to, at some point in time in the future, double the amount of income that's being generated, because all of a sudden your expenses went from $10,000 a month to $20,000 a month, because you have to pay for a nurse, you have to pay for all these different things. So self-funding, I don't think is necessarily the best option when there are actual tools out there that we can utilize that are asset-based, hybrid-based tools that we can use and plug into that planning process, utilize cash flow, utilize assets, so that once you do need that tax-free income, it's on the shelf, make a call, and we pull the trigger and it's there.
Yeah.
So.
Yeah. And I love that, because that gives flexibility in the plan, right? If God bless that no one in the family ever needs any kind of long-term care, then we didn't just flush the long-term care dollars down the toilet, kind of like traditional long-term care is like car insurance and homeowners insurance. Unless you have an accident, you're not filing a claim, you're getting no benefit from your car insurance, but you're basically funding everyone else who used the car insurance, just like a homeowners insurance. You don't have a claim, no hurricane, no earthquake, no mudslide, no tsunami, whatever, no claim on the house. So you lost that money, it's gone forever, and it was used by the insurance company for other claims. So it's kind of like the traditional policy was that way. They then tried to save it by saying, okay, well, we're going to return your premium. But what they didn't explain is that we're marking up your premium out over 50%, just so in case you want it returned, we can give it back to you. So that didn't really work either. And that really leads us to the asset-based long-term care products that really are other assets that are invested potentially, or growth assets that, if in the event a long-term care situation arises, you can then, with a tax-qualified, tax-free basis, access those assets towards long-term care and not waste dollars that otherwise would not be necessary in case you don't have that kind of event. So there's really a lot more opportunity these days to make sure that you're completely covered, and if you've built it into your plan. And if you don't know about them and you haven't investigated them because you just don't think it doesn't apply to me, it could apply to somebody in your family, and it's really important that you know how these things work.